What's up, investors? Look, I really want to get to the topic today, so I'm just going to go over the first couple of points really quickly, and then I'll talk about the vertical versus horizontal spreads and some of the ins and outs and what's involved into these strategies so you can pick better your favorite one for making money. So first, trade updates. Before I even do that, let me open up just a fresh window because I've started to explain one of the option strategies. So going into the account here, 1 second. Yeah, so by the way, I'm not going to do any edits. So just sit back, enjoy, grab a drink, make yourself some tea, pause the video, come back with hot tea or whatever the heck you drink, and join me on this conversation here. First of all, trade update. So I actually started another calendar spread here. I'm probably going to layer it with a few more calendar spreads come Monday. So it's an Apple 150 strike price calendar spread. One of the listeners suggested that I could do a double calendar spread, meaning the puts and calls with the same strike price. And from what I gather, they serve very similar function. So that's why I haven't done it. And it looks like the put spreads gives more premium for the money. So that's why I haven't done it. So far, I'm sitting at even. $4 up, so 5.63% up. And we'll see what happens next week. If the price of Apple moves significantly lower or higher, I will probably enter another calendar spread at the current mark price with the same strike price expiring at the end of the week. But we'll see what happens. So next, we're going to do account review. So that's the only trade I have on right now. Other than that, I have that Apple call that I've sold at 165 strike price. Moving on to the account review, it's going to be very short. We got these two credit spreads that are basically worthless. And then Apple was up a little bit, so was Realty Income, and Main Street Capital was on the green. But my account was only $700 up. I guess not green enough. So we'll see what happens on Monday. I'm looking forward to it. Okay, so next is the topic. So the vertical versus horizontal spreads. So why do I like the calendar spread better? And it's mostly because one of the shape of the returns curve, and I'll show you what I mean in a second. But one of the main reasons I prefer to do calendar spread, at least for right now, I'm not saying it's superior, is the ease of putting the strategy on. So the calendar spreads just requires a couple options, and you're able to pinpoint an exact strike price that you think the stock's going to land around and profit from that expectation. For me, it's somewhere near the current strike price. But you could move that, right? If you expect Apple to go up, you can put a calendar spread up a little bit on the wheel vertically. You can also move it down vertically. And you can layer as many of them as you want. What I mean by ease of execution is that you only have to worry about two option plays. If you want to get a similar result from a vertical spread, you would need to do at least two vertical spreads, which means 4 option contracts need to be involved. Now think about the slippage involved in these option contracts. Even when you're dealing with a liquid stock or a liquid ETF, like I'm dealing with Apple at the moment, it's still hard to execute without any slippage. What is slippage? Well, it's the price that you think you're going to pay the mark price and the actual price that the contract executes at. So if I want to sell it, let's say a call option for $68, I might only be able to sell it for $65 because of slippage, because of the difference, the bid-ask spread on that specific contracts. And all these trades, all these options have to execute simultaneously. So I might have to work the trade quite a bit before I get it to happen. So the ease of execution is an important part of this. It reduces slippage for sure. So that's one of the main benefits. Two, the payout ratio, it's curved. It's not a straight line. And here's what I'm gonna show you here. So I've pulled out and actually built for us so we can talk about an iron butterfly. Now, an iron butterfly, unfortunately, is not detected by Robinhood. I guess its IQ is not 300 anymore. I believe that's what it's called anyways. I might be wrong. But it's kind of like an iron condor, except the strike price at which you sell the initial put and call is exactly the same. So it's basically a pure theta decay generating play. And you can see the graph here on the right. The maximum payout is $400. So this is a really good build that I've made actually. If the price stays around the 150, you could get, anywhere from like 300, if it's 149, 327, all the way to $420. And then, if it goes up to 151 or more, it's still around 300 payoff still. And I'm really only going to be risking $80 is the downside. So it's quite a good build here. Like I would probably do this next week maybe if I decide to put on an iron butterfly, but it's only $5 change up and down, okay? So it's not that big, and the cost is not huge. It's a really good option strategy, I think, for doing the same thing the calendar spread does essentially. But you can see how the payout, the shape of the payout is different. These are straight lines, and calendar spread is more curved, but then it doesn't reach the maximum loss that quickly. So it takes longer for the maximum loss for these calendar spreads. Okay, so that's an iron butterfly. Let's build a calendar spread around the same date and same strike price to see what it looks like. So I'm going to go over to Apple, trade options, and then we'll go to February 17th, I think is where I built it. Not sure. Let me see. Oh, March 3rd. Okay, let's build a March 3rd. And I'm going to go just a week out, right? So I'm going to sell, let's say, a put around the 150 level here, strike price 150. I'm going to sell a put, and then I'm going to buy a put 1 week later at 150. Hello? There we go. So here is the calendar spread, right? So you can see how the payout curves instead of a straight line. And so the maximum payout for this is quite a bit less. All right. But, $1 less at 149. It's 138 and then 186 and then around probably 138 as well on the upside. What I want you to notice though is that as I reach this lack of profitability line and starting to get into the losses, it's a gradual slide down. You see that? It's minus $11 and 156. 157.5 is minus $24 only. At 158 it's $34, and it doesn't really reach that $65 level where it kind of maxes out until quite far out from the strike price that I've chosen. It's like $11 further out. And if I want this to be more intense, I can just do 2 contracts, right? I don't have to do one. So my payout will be double. It would be 400 like the Iron Condor, and my max loss will be around 100, and $30 or something like that. But it's gonna get there in a very curved way. So the Iron Condor basically, or the Iron Butterfly more specifically, is already losing $80 by this time, right? This one's only losing $21. So it kind of slopes you in there. You see what I mean? It's not a very hard cutoff. It's like, okay, you winner or loser, black and white almost type of thing. It softens you in there, so it gives you a little bit of leeway to be wrong. It kind of scales the profitability or the loss based on how right you are. So it may be a little bit less lucrative at the top, but I think both of them actually require a similar amount of capital. So let's see, if we continue the calendar spread, the max cost is 65. Let's see over here. I'm going to actually get the credit up front. Okay, so there's a difference. So I get the credit up front, and then it decides, okay, how much am I going to actually keep from that? The way I understand it, right? So, there are definitely differences the way that both strategies are calculated, but they definitely accomplish something very similar, right? So, oh, sorry, I wasn't showing you the screen there. So, but you've already seen it. There are definitely differences. It says max cost here, right? Max cost 65, and when you go to close the trade, this number will have increased. So it kind of works like basically watching a call option go up in value, whereas the Iron Butterfly / Iron Condor gives you the money up front, and then it's up to you to be able to keep all that money or not, right? So it just, the way it closes the trade is different. That's another thing, is like closing the trade becomes, now we've moved into exploring strategies, right? Closing the trade becomes more difficult with slippage in the Iron Condor / Iron Butterfly. Now you have 8 contracts that you have to deal with, 4 on the way in and 4 on the way out, whereas the calendar spread, you only got 4 contracts total, 2 on the way in and 2 on the way out. So the ease of execution is a big plus. So let's actually build Iron Condors here. So the difference is going to be, instead of picking the same strike price, let's actually reset and build one from scratch. Let's go to the March 3rd again. And what we're going to do is sell a call somewhere above the strike price, right? So let's say at 155. And then we buy one on top. Let's go $5 above at 160. And then we're going to go sell put at 145. Okay. And buy put, let's go $5 above at 140. So you can see how the shape of this Iron Condor, I actually recognize that it's Iron Condor up top. The Robinhood knows this strategy for sure. You can see how the profitability at the top is not a point anymore, but it's a flat line. So I will get maximum payout on this structure on the Iron Condor anywhere from 145 to 155 finish. I'll get that $200. But what's also happened is that my max loss has also decreased. I mean increased proportionally, because I've given it such a wide range here. And it's now $130 more or less. I'm sorry, it's $300 loss, $301 loss if I hit this downward limit. So if the stock goes over 160 or under 140, I know it's a wide range, but still I get hit with this huge loss. Okay, how about we try to make the wings a little tighter? I don't think I can make it $1.50 here, so it's going to be a little bit unproportionate, but we'll go $2 and then sell a call. Okay, we'll buy a call right here at $1.50. So it's not going to be equal. The wings are not going to be the same, but you get the point. So here it is, maximum loss 110, maximum gain 90, and then maximum loss 160 if it goes above 157.5. So, you can play around with the options and try to build strategies that make sense. The Iron Condors are good for giving you that huge flat line up top, but the Iron Butterfly is probably even better if you're more confident in the price that the stock is going to end in. And the calendar spread gives you kind of like that nice curvature of profitability that one might want when they're trying to pick an exact endpoint. But none of these are wrong. It's all about, like I mentioned in the previous videos, it's all about the expression, okay? So these strategies are meant for you to be able to express yourself well. I mean, you can do like a curved calendar spread. So let's go back to the calendar spread here. And look what you can do. If I pick a different strike price on one of the wings of the calendar spread, let's see. Oh, did it erase it? Okay, buy put, and then we're gonna do sell put here. Do I have to start over? Okay. All right. So selling a put for February 17th, let's say at one. How about we go to March 3rd? 150, and then buy a put on March 10th at 150, And look at what happens. Do you see how the wings are not the same now? So first of all, it's a little bearish, but look at the max loss here is 160. It's 65.43. Now it's 65. Let's see if we can alter this even more. Look at this now. I put it at 148. And look, max loss, if the stock goes below 146, it tapers off all the way into 128, so almost $200. But then everything above that is basically a gain. Do you see this? How you can contort it? It says custom here. I think this actually has a name when it's a curved calendar spread. But you can go like this to where, your max gain is at 150, but then you're still gaining all the way up into like unlimited. Basically, you're going to be getting some green as long as the stock doesn't drop below that 146 level. All right, so it's an interesting way to play it. The gains do taper off. See, it's only like $79 here at 154. It's going to keep tapering off, but it's kind of like a guaranteed green, and you're only really afraid of something going below 146. Now, this is comparing, this is just a curved way to basically build a put spread, right? So you could do something like this. Check this out. Let's reset it because it likes to reset on me. Let's go to March 3rd again, and you could, sell a put at what level are we? 148, and then buy a put and just do a put spread. Let's say $2 later. And look, it's a very similar shape, but see how it cuts off very sharp? Okay? But this one guarantees profit of $76 all the way to unlimited. So Apple could be like 190. Apple could be $1,000 per share. I'm still going to get the $76 as long as it's over 148. So it gives me kind of like that lower boundary line to get my profits early, but then look at this huge loss that I could get. I could get stuck with a $124 loss at 146 or under, and these are very sharp edges. It doesn't give me like the precision I want, right? With a calendar spread, you can get more precision at the exact point, even though it's serves a very similar function, but it's not as precise, right? The curvature of the calendar spread gives you a more accurate, higher definition of expression to what you're trying to do. I'm not saying it's better, right? It has its pluses and minuses. Just like we saw earlier, when you build the calendar spread in a curved way, forget what the name of that strategy is. If you do know, type it in the comments below. I used to know what it is. But when you do a curved calendar, it gives you less and less and less as Apple goes up, right? So if Apple indeed is like $200, you're going to get like a few dollars, right, payout. You're not going to get that $76. But it's also an unrealistic ceiling, right? Apple's not going to go at 200 tomorrow. It's just not going to happen. And so the calendar might actually, the curved calendar might be a better bet for you if you want to do a put spread. You could try looking into that instead. Okay, so there's some options for you. I'm personally, playing with some of these options. I'll probably try the curved calendar maybe next week, or maybe I'll just do a few more pointed, like equal strike price calendar spreads on Apple as the stock moves up and down next week. We'll see what I have in mind, but certainly whatever I do, I'm going to post it. So one person was really upset. That they missed my little screenshot post of the trade, of the progress of the trade. If you're interested in following that, just look for the post. I'm probably going to post a screenshot, Monday, Tuesday, Wednesday, whatever. Or just wait for the next video to see how that's going on. I'm thinking of doing a trade update every time I start the video. So if you're interested in that, that's cool. Oh, I didn't do an account review. I kind of messed up a little bit. Oh, I did do account review, but I didn't do the weeks and months. So 1 week minus 0.83. 1 month, 14% up. 3 months, it's about even. Year to date, of course, is pretty massive at 31%. And 1 year, minus 6%. All-time chart, like we mentioned before, is going to change. Currently, it's up 147. All right, so hopefully that was helpful. If you have something to contribute to discussion, please do. I would love to hear about your thoughts on vertical spreads versus horizontal spreads. And also, if you know the actual name of the curved calendar spread, you can feel free to write that down in the comments below to help the people who are watching this video and trying to decipher this and get the accurate naming of everything. All right, with that said, I'm going to end it right here. Looking forward to an awesome week of trading for sure next week. Peace out.